Hi there. Maybe you know that analysts lower their estimates. But still, NIO is expected to grow a lot in the future. From 7 billion revenue to over 24 billion by 2028. And this is great. Plus, you can also see their earnings are expected to improve over the next 5 years. By 2027, NIO is expected to become profitable. The analysts expect that NIO may make about 400 million in earnings in 2027 and almost 600 million in 2028. If that happens, NIO becomes profitable, then the stock price will rebound from the current level of $4 per share. As you can see, year to date the stock price is down over 50%. And that's quite bad for shareholders who bought this company in the past, especially at the highest peak, $50 per share. That's why you have to know when to invest in a company to find out the fair value based on its future outlook, what the market expects, and our own estimates. So based on these estimates, you can calculate the fair value of NIO. See the risk, the gray scenario, and the normal case. And as you can see, in all cases, NIO seems undervalued. Now, to understand this valuation, you have to look at the risk first, and then the reward. So, as I said, the revenue is expected to grow a lot in the future. But you have to ask the question, why? Why the analysts, or better said the market, expect the revenue to grow a lot in the future? To more than double, from 7 billion to over 24 billion. So let's start with the opportunities. Maybe you know that China EV market is expected to grow from 300 billion in 2024 to over or almost 700 billion by 2029. Compound annual growth rate of 17% from 2024 to 2029. So this is amazing. In the next 5 years, NIO should double the revenue, even more than that. And that's why the market expects this huge growth in the future. So it makes sense. Now, besides this, NIO has other opportunities. Maybe you know, if you looked at their balance sheet, that they have some cash on hand, which is about 8.3 billion at the current prices, because we have to convert renminbi into USD. So at the current prices, the total cash is about 8.3 billion. And as you probably know, the market cap is about 8.3 billion. So NIO is traded about the cash on hand. Now, you also have to be aware that they have some debt, about 13 billion renminbi. But if you subtract this debt from their total cash, their net cash position is about 6.5 billion. So that's good. They have a good balance sheet. They have cash to fund their operations. So besides this cash on hand, you also have this future growth rate, that this business may become profitable in the next 5 to 10 years. That's great. But why the stock price keeps going down? As you can see, year to date is down over 52%. Quite bad. As you probably know, if you look at their deliveries and the whole industry, you can see that Tesla, Liado, and other companies have reported a slower growth rate and the number of deliveries. But overall, if you focus on the long term, you can see that the revenue is expected to grow a lot in the future. Plus, they have tailwinds from the EV market, especially China, their largest market. You also add their cash position, and NIO is expected to succeed in the future. Of course, besides this, they also have other opportunities. For instance, international expansion. As you can see, NIO is considering building a dealer network in Europe to speed up their deliveries, to sell more cars and make more money in the future. And that will be great for You, if you are a shareholder or if you plan to invest in this company. Now, these are their many opportunities. Of course, they also have other advantages like battery swaps and others, but you have to focus on the main points. What you can expect from this company. So you don't have to get in details. Just the important opportunities. Now let's continue to focus on the risk. The first risk that I don't like about this business is dilution. As you can see, the number of shares has increased in recent years. From 1 billion to almost 1.7 billion, and more recently, if you read their annual report, to about 1.9 billion. So they almost double the number of shares. And this is bad for you as the shareholders because you lose in value over time. If they double again the number of shares, you lose half of your value. Because you have to divide your profits with the other shareholders. The more there are, the lower your profit gets. I mean the profits per share. So you have to be aware of this dilution. If it keeps growing, then your value decreases over time. Of course, if the growth rate, their growth rate in revenue and earnings is higher than this growth rate in the number of shares, overall, you'll do great as an investor. But as I said, you focus on the opportunities and also on the risk because they may happen. You never know. The second risk is competition. As you probably know, in China, there are more players, and the major players in China are BYD, Geely, and Tesla, and of course other Chinese companies. But I don't see any NIO here in this image. You can also look at the number of deliveries for each company, and you will see that NIO is at the bottom. Now, this may be bad, but also good, because NIO has more room to grow. If they improve their cars, they become more efficient in their operations and lower their prices, of course, and also deliver high quality, they have room to grow, to gain more market share. And they might compete with Tesla and BYD for the first place. Now, the third risk is that the more competition there is, the lower their profits will be. You can easily see from their income statement that this company, NIO, has low margins. In general, other companies have low margins. You see total revenue about 46 billion and total cost almost 30 billion. And loss from operations was with minus 4 billion for 2021, minus 15 billion for 2022, and minus 22 billion for 2023. Of course, this is in renminbi, not US dollars. For 2023, their loss from operation was about 3 billion. So you have to be aware of their margins and that this business requires high capital. They have to invest a lot in infrastructure and hire more people the more they expand their business. And this is bad because they put pressure on their margins. And if you add on top of this low margins, the competition, then their future profits are likely to be low. As you can see here, by 2028, NIO might make 24 billion in revenue, but only 600 million in profits. So that's why you have to be aware of this business. Their margins are quite low. Now, as you've seen, there are opportunities and the risks. Let's go to the valuation. First, let's start with the gray scenario, because maybe you want to focus only on the reward. You don't care about risk. But this is bad. You always have to focus on the risk. So let's start with the gray scenario. As you can see, based on the analyst estimates, if NIO delivers about 600 million in earnings, then the fair value may be about $10 per share. And as you can see, the share price, the current stock price is about $4. So you have a margin of safety and a nice return, over 10% a year. Of course, As you've probably seen, this valuation also includes their net cash position, which is about 6.6 billion. If you remove their cash position, then the fair value per share would be about $6. If NIO delivers over 600 million earnings and they keep growing, this can happen. So it's up to you if you want to include their cash position or not. Because you may include now their cash position, but as they have so many losses, over 3 billion in loss from operations, their cash position is likely to decrease over time. And after 2 or 3 years, your value won't be the same, will be much lower. So you decide if you want to value this business by adding the net cash position or not. So it's up to you. You have to see both scenarios, with the cash on hand and without it. Now, let's see the normal case. As you can see, the fair value for the normal case is about $8 per share. If you remove their cash position, then the fair value be about $4.80. So you have to be aware of this scenario. Now, let's look at the risk, the bad scenario. As you can see, if you add their cash position, the fair value per share will be about $6.40. So the current stock price, you still have a margin of safety, and that's great. You can take advantage of these low prices. But if you remove their net cash position, then the fair value may be about $3 per share. Of course, this can happen only if they don't achieve profitability or they deliver lower earnings than expected, less than 600 million in the next 5 years. So you have to be aware of this risk. Of course, if NIO delivers 1 billion in earnings in the next 5 years, then you can see that the fair value can be about $5 per share for a 10% annual return. So you have a higher margin of safety if that happens. That's why you have to see all the scenarios and buy when the stock price is below the fair value. Of course, taking into account the risk. So if NIO doesn't issue more shares in the future, let's say they remain stable about 1.9 billion, then this company may become profitable as the market expects because they have good tailwinds from the EV industry and also international expansion. This can happen. But if they continue to burn more money to report higher losses in the future, then their cash position will decrease from 6.5 billion to less than this, and they have to find new funds to fund their operations. And the easiest way is to issue more shares. But this is bad for investors. That's why you have to be careful. See the reward, what can happen. Yes, the stock price may more than double from the current level, but also focus on the risk. Dilution, competition, and low margins. Because this business requires a lot of capital to expand in other countries. So, it's up to you. You decide how you want to invest. And if you have other questions about this business or other companies, please let me know in the comments.